Separately stated items. This is a big topic. Also one that we will see a lot more in S Corps and then partnerships. So this is an introduction to it. We'll see it again. And then feel free to come back, watch this again. As I've said throughout this lesson, and I'll continue to say in other lessons, in a perfect world, we see everything at once, but is that physically possible to see everything at once? No, not at all. So yeah, go take a look at separately stated items within the lessons. They apply to S Corps and partnerships. They apply to flow-through entities. And then when you come back and see this lesson, you'll think, oh, wow, okay, it's all coming together, right? But in those lessons, we will talk about how these separately stated items affect your personal, individual, taxable income. Now, separately stated items, these are going to be items of income, loss, deductions, just a bunch of other things as well that are separately allocated to the partners or shareholders of a partnership or an S corporation on their Schedule K1. If you have no idea what I'm talking about so far, no worries, I'll make sure you understand. These items are called separately stated because they must be separately reported on the individual taxpayer's income tax return and not simply included in their overall income. Now, for individual taxpayers who are partners in a partnership or shareholders in an S corp, separately stated items are important because they are going to affect your taxable income and liability. I'm going to give a super brief, we've got many other slides in this, but super brief introduction to all this. For a C corporation, just a normal corporation, think about if you invest in Apple. They've got a bunch of items on their tax return. None of those affect you. The only thing that affects you is if they pay you out a dividend. No separately stated items exist for a C corporation. However, we are going to see that for S corps and partnerships, which are flow-through entities, which the purpose of those is they flow through income to you as the individual shareholder or partner. However, some things like ordinary income, expenses, normal business things will be on there, but we'll see things such as charitable contributions and interest income and some other things that actually don't get reported. Well, they do in a way, but they don't get included in the income here on the entity level. However, they get sent over to the individuals. And you as the partner or you as the shareholder in the S corp have to take these items and apply them to your individual return. Why is this important? Well, one, you need to memorize what are separately stated items. That's a great step one. Is as you see in here and as you see in other lessons, first off, you definitely want to memorize the items that are considered separately stated and then be able to distinguish what belongs in what tax form. That's, again, critically important. You'll get that there. And then we will see, okay, you're doing a SIM where you have to complete a 1040, someone's individual return. They give you an S corp return. What items from that S corp return do you have to include on your individual return? So you see how that could definitely play a role in not only real tax calculations, but also in a SIM. Here are some examples. Now we've got, I'm going to show you the actual K1 first. Going out of order, I'm losing it. Here we go. Here's the Schedule K1. Now this is the K1 of an 1120S, which is the S corp. It's very similar, but it is different for a partnerships K1. It's a very similar format. Now these are separately stated items, and if you wanted to look at the tax form, and great way to memorize what are separately stated items, there you go. Now there are other items that are separately stated that go into other deductions or other income, so this is not a completely comprehensive way to memorize it, but generally what happens is your S corp has a bunch of items on it. Then anything that's separately stated, it goes on its Schedule K, which is still part of the 1120. Then let's say you're a 50% shareholder in the S corp, and let's say they had $1,000 of interest income. Well, we see interest income separately stated because it's on the K1. If the S corp had $1,000 of interest income and you're a 50% owner, you're going to see $500 here on interest income. And this gets slapped onto your individual tax return, and then this would flow. And we'll talk about this. I've got all the tax forms linked up in our S corp lesson and within partnerships as well. You'll see the flow of that. This is just a nice introduction to all of that, not to dump too much all on you at once. So that is kind of how that works, just giving you insight into it. And if you want to get familiar with how the K1 works now, feel free to do so. Here are some examples. So ordinary business income or loss. This is the partnership or S corp's net income or loss from its business operations. So while these items do get reported on the face of the S corp or partnership return, it eventually does flow through to the Schedule K, then the K1, then you as the individual in your 1040. It's allocated to each partner or shareholder based on the percentage of ownership in the entity. Now, this income or loss is reported on the taxpayer's individual return and is subject to the same tax rates as other income or losses. Capital gains and losses. We'll just see these here. We'll dive through them. You can take a read on them, but really nothing too groundbreaking in any of these. We've got capital gains and losses. If the S corp has any capital gains and losses, those flow through to the individuals. Same with interest income, expense, and then charitable contributions. These are just some examples, some of the more common examples. And then where do we see those? We see our ordinary business income or loss up here. Like I said, not all of these will be included. Charitable contributions would be considered other deductions. We see interest income, so we see some things explicitly stated out. We have our capital gains and losses here. Just get familiar with those and where everything would go in the tax forms. Some more examples: dividends, rental, real estate income or loss, and Section 179 deduction. These are all items we'll see many more times throughout the life of the course, and you will get to know them. You'll become quite familiar with them, but just get to know that these are going to be separately stated items. Take a read as you want, but not too difficult here. Here's an example for separately stated items. Now, again, this is something normally you probably wouldn't see until you get to S corps and partnerships, but it's kind of think of this like extra credit. You're really starting to get an idea that these exist and understand the gist of it before we get too deep, making sure that, again, you do know this is very heavily tested, very important for the exam. Now, suppose Jane is a partner in an ABC partnership with a 40% ownership interest. During the year, the partnership had the following items. Take a look at those in a second. As a partner, Jane's going to receive a Schedule K1, and the partnership is going to give out a bunch of K1s to all the owners. I mean, maybe there's a 40% owner and a 60% owner. In that case, there would be 2 K1s, but if there's a bunch of owners, if there's a bunch of 5% owners, they would give out a bunch of K1s. However, Jane's going to get a Schedule K1 with her name and info and all that, just like we saw on the previous slide, with her share of these separately stated items based on her 40% ownership interest. So her allocation, we got 40% of the ordinary business income, 40% of the capital gain, 40% of the interest income, and 40% of the charitable contributions. Now, how is all of this going to work? Jane is going to report these amounts in varying places as well. That's something I'll go over significantly in our S corp and partnership lessons, is specifically where do these go? Do they go on the Schedule E? Do they go on the Schedule D? So all these items find their own home on the various schedules of the individual tax return. Ordinary business income of $40,000 will be reported on her return, and this is going to be subject to normal, regular tax rates. Long-term capital gains will be reported, and these are going to have the more favorable long-term capital gain rates, depending on her overall taxable income. Interest income will be reported on her return, and that's going to be taxed at the regular rates. And then charitable contributions will be reported on her return as an itemized deduction. So you see that's going on Schedule A, subject to the standard limitations for charitable contributions. So this is not just a normal deduction. This flows through. That's why they call S corps and partnerships flow-through entities. This flows through to her individual situation, and then it's applied there. The S corp doesn't care about what goes on with that. The partnership doesn't care. It's up to Jane to figure out what to do with it all. Now, by separately stating these items on her Schedule K1 and reporting them on her individual return, Jane can take advantage of the different tax treatment that applies to each type of income or deduction, which results in a more accurate reflection of her tax liability for the year. Basically, do a little tax planning for yourself. There's a lot of items here, and they're going to affect a lot of different people's tax situations differently. And that's what Jane's going to see. Calculating gross income. Got more examples. Gotta love them. We have lots of them. Sarah is a self-employed graphic designer. What form is Sarah going to fill out? Well, Sarah's going to fill out the Schedule C. Get a little bonus points there. Make sure you know what forms we're going to need in each situation. In year 1, for the tax year, she earned $80,000 from her freelance work. To calculate her gross income, she's going to need to add up all of her income from various sources. Here's a breakdown of what she has. Just more and more examples of items you can see on the exam. The more familiar you get with what you can see, the less will shock you when you see examples, you see questions, and then you get to the exam. So income, we see here $80,000 from the freelance work. We have interest income from a savings account. Cool, we'll add that as well. Dividend income from stock investments. Yeah, no reason we wouldn't add that as well. Again, general rule, it's includable unless we went over some rule in this course as to why it wouldn't or only partially be includable. And then rental income from a property she owns, $8,000 there. Gross income is going to be all these added up together for $89,700. Note that all gross income includes all income from whatever source derived. Boom, 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 everything there. Fringe benefits, we're dealing with these a little bit more. So when an employee receives free usage of an employer's assets, such as a condominium, why do we mention that? Because we'll see an example with that. The value of this benefit is generally considered a fringe benefit and is taxable. We saw other examples, such as gym memberships and the like. The fair market value of the benefit must be included in the employee's gross income and is subject to federal income tax, Social Security tax, and Medicare tax. This is going to go on the W-2. So just like at the end of the year, you get, or at the beginning of the next year, you get a Form W-2, which is probably one of the biggest components of each person's tax return. It goes there. These fringe benefits would be reported on the W-2. Now, there are some exceptions where the value of the fringe benefit may be excluded from gross income, such as a working condition fringe benefit. Now, this exclusion applies if the employee's use of the employer's property is for a legitimate business purpose, and the employee could deduct the cost of the property usage if they had paid for it themselves. We'll see examples. However, this exclusion typically does not apply to personal use, such as vacation of an employer's assets like a condominium. In most cases, the personal use of an employer's property is considered a taxable fringe benefit, and the value must be included in the employee's gross income. The taxability of these fringe benefits primarily applies to the employee who receives them, as they're considered a form of compensation by the employer. We'll see how a spouse might use your fringe benefit, and we'll see how that applies here. Got the example. Generally, the employee is responsible for reporting the taxable fringe benefits they receive as part of their gross income. So you may not have the employer put it on your W-2, but you're responsible for making sure you report that. However, if a fringe benefit is extended to an employee's spouse, dependent, or other person, the value of that benefit is still considered part of the employee's taxable income, even if the employee themselves did not use the benefit. So in this example, Emily works for a company that offers a gym membership as a fringe benefit. The annual cost of this would have been $1,200 if Emily paid for it. Emily decides to give the gym membership to her spouse, John, instead of using it herself. Even though Emily is not using the gym membership for her and John's using it, it's being used by her spouse. The value of that is still considered a taxable fringe benefit. In this case, Emily's going to have to report $1,200 as a part of her gross income for tax purposes. Now, it's important to note that not all fringe benefits are taxable. We kind of talked about how some are excluded. Other examples, certain educational assistance, health benefits, retirement plan contributions. Some of these may be excluded as well. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.